Hey, it's Kevin and Fred. Do you have a referral for us here in Phoenix? There are 30,000 agents here that you could send them to. Why us? Well, for one thing, we'll keep you updated and you'll never have to track down your commission.
We'll also make you look really good to your client. And best of all, it helps us keep all this content free. So go to kevinandfred.com/referral to make the introduction. We'll take great care of them.
All right, Next Level podcast listeners, we're back, and I'm excited today. Today I am joined by Todd Sherer, who is the founder of a company called Fleq, which is how we ended up on this conversation together. Because you might recall we mentioned the company on a recent episode of Industry Headlines, and so in the effort of kind of learning more about what's going on in the real estate world, especially when it comes to tech and fintech and just the changes overall in what's happening in our industry, I thought it'd be cool to kind of dive in a little bit and hear from Todd himself. So Todd, welcome to the Kevin and Fred's Next Level podcast. I appreciate you taking the time out of your busy schedule.
No, I appreciate the opportunity to talk about us.
Yeah, well, I know as a founder, I'm sure you're very busy, so I just want to let you know we definitely appreciate and respect your time. Why don't we start with, I obviously want to dig into Fleq, and that's, the bulk of what I'd like to chat about today. But rather than going straight into that, tell us a little bit of how we got here today. Tell us about your story, Todd, and in the financial world and in real estate world. Like, how did we end up here today?
Sure. So I've actually been in real estate and real estate finance, mortgages, for almost 25 years now, and it scares me to even say that. But I've seen, now several different cycles, and I was at Countrywide Securities Corp, the broker-dealer for Countrywide Home Loans, leading up until, 2008. After 2008, I left Countrywide and joined a hedge fund, actually. And so, I was going through buying MBS and other distressed mortgage-backed assets. I launched my own hedge fund in 2012 called Illumination Asset Management. And now we're, kind of embarking on Fleq, which is kind of a culmination of the journey. I'm asked a lot about, what is the aha moment, or when you decide that you're going to, fight something as entrenched as the mortgage in buying real estate. Why were you blunting your head against this to bring it? And, I'd love to tell you it was some, personal tragedy or something along those lines. But, there were a series of kind of aha moments and, that really kind of led up to this. But, I was, again, at Countrywide in 2005, and I had just bought a condo in Santa Monica, California. And, my partner on the desk, about 6 months after I bought it said, that in, 2 years, I'm going to buy your condo for half what you paid for it. And I said, yeah, but you're going to have to do it in all cash. We had no idea that, obviously 2008 was going to roll through and do it as deeply as it did. But, that's still a moment that resonates with me. That was probably the first moment of a light bulb going on. I just didn't realize it was a light bulb yet. As I was at Illumination, we were looking at a way to refinance people who were stuck in contract for deeds. And, contract for deeds are generally the most egregious form of housing finance ever created. And, they were the big target of the CFPB, several $1 million fines being levied. And we were trying to figure out a way to help those people out into a different product. And that was really where Alliance 1.0, was kind of germinated. Ultimately, we didn't do a whole lot with that. There was issues with us getting in and people wanting to take all of the contract for deeds off their books, and we didn't want to deal with that. But that's really where it became. It focused on what is a sustainable way to get people into home ownership. And, the challenge of home ownership has always been thought of as basically being in two dynamics. One is affordability and one is attainability, meaning, can I get a mortgage? Is the economy good? Is credit prevalent? And affordability has always been thought about at just point of sale time, right? How much money do I have to put down to get into the home that I want to look at? And, the Alliance 1.0 from the contract for deed perspective kind of morphed into what we're doing today as we started thinking along a lot different lines. Affordability can't just be thought about as getting people into the home, right? What are we doing for people who, you know, have that major repair? Like they stretch to get an FHA loan because they want to own the home. What happens when, you know, the hot water heater breaks, right? That, you know, there's a 2017 Fed study that said the average American family can't afford a $400 bill without having to borrow or sell something. You know, that may have been a little exaggerated, but the point being is, you know, people are still too much living on a shoestring. So we wanted to think about affordability over the life course. And as we looked at, you know, millennials saying, you know, look, we're just not taking up housing. You know, they were just getting to their formative years in 2008, seeing their parents' equity being wiped out. They have a general distrust for banks and financial structures. And we said, well, what makes sense to them? What in their life makes sense? And so we wanted to add another 4 metrics to the hurdles of housing, you know, which are flexibility, portability, sustainability, and convenience. And for us, flexibility is, although you do have to make, you know, an initial equity contribution, which is similar to a down payment, once you make that, you never have to buy a slice of equity with us again. If you want to be a renter in perpetuity in your home, that's fine. We're okay with that. You know, we want to give you that optionality, but we also want to give you the optionality that you can buy some or all of your home from us at any time at a known price. We also wanted to make it.
Sorry to cut you off there, but so I'm curious about that. Tell us, let's walk through that. Like, so what are the steps, or how does the Fleq program work, or product, if you will? It's funny because when I first read about you guys, my lender, who I work with here in the Phoenix area in my real estate business, sent it to me, and you know, obviously the headline was, you know, buy a house without a mortgage, you know, and I was like, what? Okay, that's interesting. Tell me more. And so I'm interested in learning more about this. So give us the overview, if you will, of what is this program, what's it like, and I'd love to kind of just dig into a little bit of the detail.
Sure. So the alliance is essentially a partnership between us and our customer. We call them members. And so in the alliance, they go and find the home that they wish to live. So this isn't, you have to look at what's available for rent. Any home that's available on the MLS, Zillow, wherever you're coming about, the housing product is available. And what we do is then we're going to, you know, do a credit application. We call it Rental Plus. We're really more focusing on what's the likelihood of you surviving a 3-year lease with us, because that's your initial term. And so once we get beyond that, we look a little bit closer at your credit. We determine how much your initial credit contribution needs to be to the partnership. And then we say, okay, well, you want to buy 123 Main Street. It's listed for sale for $100,000. We think monthly rent on that would be $1,000. We would require a 5% initial capital contribution on your part to the partnership. And if you want to move forward, then we would start the process of getting the traditional appraisal, having a home inspector go out and make sure that the home's in good condition, and setting up the legal framework for the partnership. And once that happens, we come in and we'll bid the home for cash.
Okay. So let me ask you this. So, because you mentioned something earlier, so I'm going to hop around a little bit. So sure, let's say somebody does it. They identify this house. It's, you know, it's the $100,000 house on Main Street that you just mentioned. And so they've got this initial equity into that home, but let's say 4 years, 5 years down the road, they go, you know what? I don't want to live in, you know, wherever you can buy a home for $100,000. I don't want to live in Tulsa. I want to move to Tucson, Arizona, or I want to move to wherever. So do they have to sell their partnership, their portion of the partnership? What does that look like?
Right. So again, so they can move from Tulsa to Tucson in a variety of different ways, right? They always have the right to sell the home subject to our right of first refusal. And what that really means is we need to protect ourselves that you're not going to sell it to your brother Bob at 50 cents on the dollar and expect us to take a loss on it, right? But in practicality, we know no realtor is going to work on selling a home that's subject to a ROFR, right? Well, why am I going to spend all this time and have someone take it out from under me? So in practice, what that is a sell above price. So if you can sell it above X price, we'll agree to pre-waive the ROFR, you know, then you can move forward with the transaction. We would be working with them and their choice of realtor. We don't mandate they work with anyone in particular, even though Fleq does have to be licensed as a real estate broker in jurisdictions that we operate. So you don't have to work with us. You can work with whomever you want, and we'll work on that sell above price. The other part, as you mentioned, we do offer equity portability. And so depending on whether, again, certain states will be done a little bit different, whether it's an LLC or a trust, what happens is you essentially port your equity into that new home. And so in some cases, yeah, you'd be essentially selling your capital back to us, depositing it in a new LLC in Tucson that you were moving to, and you begin a new alliance, but you don't have any selling costs. So you're not paying, the 5.5, 6% selling costs. You're literally paying for a new application fee, and then you're picking up and moving. And we call that frictionless moving. So you're not burdened with it. We take back the property. We decide whether it's going to become a rental. We decide whether or not we're going to sell the home. We'll deal with the disposition of that asset going forward. But what happened for you is if you build up, $10,000 in your home in Tulsa, you'll port immediately with $10,000 in Tucson. And assuming that, your house in Tucson is $200,000, it would be the same 5% down payment. There's no more cash that you need to contribute to into the partnership in the Tucson home. We will have obviously agreed on a rent on your Tucson home going forward, and literally you're just moving into that home. Importantly, all of these things are on sliding scales, meaning, and what I mean by that is, we focus on the fact, and we've got a lot of questions about, well, how does the rental payment compare if I can get a mortgage? And the answer is it really doesn't, because obviously your rental payment is generally going to be higher than your mortgage payment in this day and age. But you only have to rent the portion of the home you don't own. So if you own 10% and the rent in our example earlier was $1,000, you would be paying me $900 a month in rent, and you would be responsible for only 10% of the ownership costs. So taxes, homeowners insurance, repairs, all of that, you're only paying 10% of that. Every dollar that you contribute to the partnership buys a dollar of equity and effectively increases your ownership costs, but reduces your rent going forward, not just in your new lease, but next month. So if, again, it was $1,000 and you own 10%, you pay $900. If you bought another 1% of the home, next month your rent would be $890. And importantly, ownership costs are merely pass-throughs. We pay the same amount on the opposite side, right? So if you're paying 10% of the ownership costs, we're paying 90%. Those are all pass-throughs. We do have a profit motivation in the rent. So every dollar you put in is taking, a cent out of the transaction forever, basically. So every dollar you put in does reduce the total cost of the transaction. And then obviously we don't think of ourselves on terms of the mortgage, again, because of, what happens when something breaks down in your house, right? You've got to get on Yelp, Angie's List, wherever you're going to find the plumber, electrician, whatever. You're calling your dedicated property manager, who's then sending out a licensed bonded contractor to handle the repair. So you're not thinking about it at 2 a.m. All of that is then provided as part of the bargain, with the Fleq Alliance.
Okay, so that kind of that would work similar to like a traditional rental, like, hey, my washing machine breaks down. So you call the landlord or you call the property manager and they fix it. You're not necessarily going to Home Depot or Lowe's tomorrow to go buy a new washing machine yourself.
Yeah, 100%. And that's I guess an important point. I mean, what we've done in creating the Alliance is we've taken pieces of home ownership, we've taken pieces of rentals. Some people think we've shared stuff from timeshares with the fractional, kind of ownership. And we've created what we think is a completely new structure. I mean, I've said, people have asked, well, what's the difference between, a mortgage and an alliance? And, it's kind of an off the cuff, somewhat glib answer, but it's very true. A mortgage is a way to buy a home. The alliance is a new way to experience home ownership. I mean, this is just a completely different model of anything that's been done before.
Yeah, it's extremely different. Let me ask you this, because I don't know why this just didn't dawn on me till a couple seconds ago. But if there's no mortgage interest deduction. However, I know if you're a landlord, you can depreciate the property. If I own whatever that is, 10% of the equity, does that mean I can depreciate 10% of the equity on my taxes, or how does that work?
No, unfortunately, the IRS will say that this is your personal residence, and you can never deduct depreciation on your personal residence. Okay. So, unfortunately, yeah, it's you lose that. You definitely lose that depreciation. But one of the good things is, first of all, only 37% of the people in the U.S. actually itemize on their taxes, right? So to collect your taxes and interest, you've got to itemize anyway. And now that we've raised the standard deduction, I don't know what that number is from last year, but I'm guessing it's substantially less. So there's less people that are going to claim the mortgage interest deduction anyway. But yeah, it is a valid point. You do lose that interest deduction, if you were taking it, because there is no mortgage, there is no interest associated with the transaction.
Okay. And then, so gosh, this is fascinating for me. Let's say, so you gave the example, $100,000 home. And I kind of like, I'm in Phoenix where you just buy something for 100. It's not Santa Monica, but it's also not Tulsa. Oh, so what about, okay, like you mentioned Santa Monica, like you're not buying something there for under probably $750, and that's for a very small home, right? I'm assuming that's probably not ideal for Fleq, but what is ideal for you? And like, what are the ranges that a customer of yours would actually be in?
Look, so there isn't an ideal range, and it's really about the customer, not the property. Okay. For instance, if you were, a CEO who's now consulting, right? You've got a 2-year gig. You want to live in a nice home with those 2 years. You may still want to build equity. You may still want to be a homeowner, but you're not going to live in that next city beyond that. We could be ideal for a relocation program. If you're a foreign national and, you want a condo off Central Park South that's going to be $50 million, I mean, that's probably not exactly ideal for us, but, we can do it, right? Now, obviously, we think our target audience is really going to be, part of the $4 trillion of rented real estate that's out there. People that are displaced from 2008, may not have been able to get on their feet yet, want to own home ownership, and also millennials who may want to skip that starter home and get into something a little bit more. Maybe they can't get a mortgage because they have too much debt. Maybe they have a good income, but again, the DTI is, kind of messed up. We can accommodate all of that. So, we think that our normal buyer is going to be, some combination, again, not a normal buyer, but we'll see a bifurcation between, people who are renting and more coming into, entry or entry level plus housing, and millennials who may be skipping that entry level housing and going to that next level, on the lower down payment. But, quite frankly, unless you have an 800 FICO score, you have 20% to put down, you never plan on moving, that guy, I'm going to tell you to get a mortgage. Like, you shouldn't be with us. That's fine. But, for everyone else, the convenience factors, the equity portability, the fact that this isn't debt, this isn't going to affect your credit score going forward in a negative way. You have the initial and ongoing affordability. There's a lot of people that I think that our product would work for beyond those two traditional groups. But, obviously, those are kind of our sweet spot as we think about who our customer becomes.
Yeah, it's fascinating to me. I mean, I love the way you guys have, reimagined this. I'm sure there's a lot of kinks and stuff still to iron out as you guys grow. That's probably the name of your game, right? At this point in your growth, of growing the company. But I just love the idea that you guys took something and you flipped it and looked at it. It's kind of like a guy who's a bit of mentor, not a personal, I don't know him personally. I just read his stuff, listen to his stuff, is Peter Diamandis in the tech space. And he's always talking, you just got to look at stuff a little bit differently. Or Dan Sullivan's always talking about just look at it from a slightly different viewpoint. And I feel like that's what you guys have done. So, all right. So I digress. Let's go back. So we started talking about kind of what that beginning process looks like. What else is there? You started mentioning it. I think you called them a couple, there, for lack of a better term, F words, I think you said. You talked about the flexibility. What are some of the other things that are like key components that people should know about Fleq and what's going on with what you guys are doing?
Yeah, I mean, I think it's the 6 hurdles, right? The affordability, attainability, flexibility, sustainability, portability, and ease. And we've kind of hit through, a lot of those. I think that one of the things that, we want to do is, there's definitely an aspect of sustainability, right? I mean, look, I've been in the mortgage industry for, again, real estate and mortgage for over 20 years, almost 25 years. And the mortgage is a tool, right? And, we kind of say it's, a mortgage is a shovel, right? When times are really good, that shovel can look like a backhoe. And when times are really bad, that shovel looks like a garden trowel, right? But it's always a shovel. We wanted to create something that looked more like a Swiss Army knife that, fit everybody's different needs, that was varied enough that, again, we offer the flexibility that, look, if you want to make standard payments and here's my monthly rental payment, here's my ownership payment, and here's an additional equity payment, and you want to do that every month just like you do with your fixed rate mortgage, great. If you want to pay your rent and your ownership expenses and, wait till you win the lottery to buy, additional equity, okay, fine, right? That's okay too. We want to make sure that when we're creating something that, again, and from the sustainable part of it, we're qualifying you on the rental. We're not adding debt to you. The average person loses about 20 credit score points when they get a mortgage, just simply because you're taking on additional debt. When with us, you're not taking on additional debt. You're partial owner of an asset day one. And, unlike the rental portion where, we always joke, when's the last time the landlord let you paint the walls? With us, you get to treat the home like it's yours because you are a part owner. You want to paint the walls green? Okay, fine. Maybe not my choice, but that's great. You want 6 cats? Okay, maybe not my choice, but, that's fine as well. You get to treat the home. You get to act as if you are the complete owner, just like you do under a mortgage. And you get to, again, the right to sell the home if that's what you want. If you decide it's time to sell, we can't say, hey, wait a second, we think that the property is going to go up another 6% over this 6 months. You should really hold off. You want to sell, we give you a sell above price. You hit that, you're out. We drag along. So there's all those aspects that you get the benefits of the traditional mortgage of, kind of treating the property like it's your own. You also get the benefits of renting, meaning you call someone up when something breaks and it's fixed. Again, and it's all flexible on your schedule. The only thing that's fixed is the first lease we have with you is 3 years. After the end of that 3-year lease, you can roll it 1 year, automatically. You can say, look, it's the end of the lease. I don't want to do this anymore. I don't want to be here. And we'll look at options to either buy out your equity or sell your home, depending on what's best. Or you can sign another 3-year lease with us. So again, there's all these points of control for, our members, as we call them. So, we want to make sure that this is a product that they're invested in, because again, we think of this as, that potential life cycle product, meaning, I was, kind of shocked in a way to find out the number of millennials who want to get a home because they want to have a pet and they can't in their current, environment. And I was like, well, I get it. I mean, I was surprised by the number being as high as it was. So, you get the home to get the pet, and then you add a significant other. Maybe you're doing well, you combine your income, you want to move up. Well, with Fleq, you port your equity to that new home. If you have kids and need to move again, well, you port and you move again. If one of the things we haven't talked about because, we're so far from getting to that point, but, once you get over a certain level of equity, you'll actually be able to apply to us to sell back the equity to us. So the kids are grown, they go to college, you need to sell some home to pay tuition, you can sell it back to us at again, the same price you can buy it at. If the kids are now empty nesting and you're leaving, Tulsa and going to Phoenix, you can, again, port your equity one more time. Now, there are definitely membership fees that will go along with each one of them, but they are a fraction of the cost of selling the actual home that you left behind. So how many 5 and 6% transactions have you left behind, in my example, by staying with us through that process? So again, we want to create this to be frictionless as possible. We call it frictionless moving, so that you can pick up and focus on where you want to be. And we want that product that grows with our customers so that it's not, oh, I have to sell home X. I had a great, mortgage experience with Quicken, Wells Fargo, Bank of America, Citibank, put all the lenders in there because I don't want to offend anyone. Now I got to do it all over again with them, right? With us, it's more of an ongoing process. We already know how you've behaved over the last 3 years of the lease. Are you performing? Are you a good credit? It makes it easy for us to port your equity to a new home. And whether that be, across town, across the state, across the country, we ultimately want to offer that to you.
Wow. That's gosh, it's such a fascinating concept. That's really cool. So you mentioned when I was asking you kind of about price range, you're looking for the tenant or the partner, the member is your word, not so much the price range, or the city or the town. Do you guys, is there an ideal? Is it really just that it's that group of people that are still renting today, or maybe should be renting? We'll call them the first time home buyer pool. I know there's I've got a lot of folks, a lot of friends who are in the space of working with companies that buy just buy homes for their portfolio in the hundreds and in the thousands to rent out. A lot of it is because that first time home buyer, it's the number you mentioned. It's like I don't know if it's exactly true to that number or not, but a $400 bill wipes out a lot of families, right? It hurts a lot of families. And so
Definitely.
there's some talk of, a lot of people who are homeowners maybe shouldn't be homeowners because of that. I think the opposite side of that argument is, yeah, but we know that over time, obviously 2000, the crash was the crash. But we also know over a given period of time, that's also the one way that most families in this country make a good portion of their net worth, for when they get a little bit later on down the road. So this to me kind of seems like that middle of the road option of be able to kind of have the best of both worlds.
Yeah, definitely. And I think you're absolutely true. And one of the reasons that, we're a little bit concerned about the millennials taking up home ownership in smaller and smaller increments is exactly what you said. The single biggest wealth builder in this country are homes. Again, outside of the crash and outside of events over the long term, that's what it is. And so, we definitely see this as, whether it's a middle road or maybe the better road, or, we would certainly think of it in those terms.
Right.
It's a way that you get in now. You can start building equity over time, as early as you possibly can, but you're still getting to retain all that flexibility, right? We're getting a rent payment for it, right? It's not completely altruistic. We're making a profit when we do this, but you're getting, you're kind of getting to wade into home ownership, if you will, right? You're getting your proportional, equity appreciation along that way. As you're getting, as your job is improving or your salary is improving, you can start putting more money down. You can build it. You drop your rent. You increase your ownership score or the ownership costs. So you're effectively becoming a bigger homeowner. And again, we're going to monetize the home price appreciation along the way. So one of the things that we haven't talked about that I think is actually really important is that, we say with a mortgage that we have equity, right? We don't really have equity, right? So when you buy your $500,000 home and you put 20% down, you say you have $100,000 equity. But, as you know, in Phoenix, if it falls 20%, you have no equity and the bank has, essentially your home. With us, your equity is your equity, meaning it floats with the value of the home. So, akin to, Apple shares, right? Apple can be 318 or whatever it closed at today. It can fall to 250. If it falls to 250, you still owned your 100 shares or whatever it was, and you can buy more at 250. With us, it's very similar, meaning that every year we go out and revalue the property. And I'll go back to our $100,000 home because the math is really simple and I prefer that.
Okay.
So in the $100,000 home, our partnership may have 10,000 $10 units. Okay. We want the price to be very small. We want you to think, instead of getting a large pizza on Friday night, I'm going to get a medium and I'm going to buy a unit of my house. That's how granular we want the decision to be. But every year we're going to go out and revalue the home and we'll provide you that valuation. It'll be IAG compliant, done by a third-party appraiser firm, and we'll provide it to you, and that's the new price of your home. So if it says it's $110,000, those 10,000 units are now valued at $11 a share. So if you're buying more units from me, you're now paying $11. I'm monetizing the home price appreciation. But the converse is also true, meaning that if that home is now worth $90,000, those equity units are worth $9, and you can buy those units from me at $9. So we're floating with you. So there's no more need for strategic default. There's no more need for, all the things that happen with regard to a mortgage.
Do you have some sort of built-in protection on that? Here's what I thought, because I'm always thinking strategy and gamification with business, right? So let's just say you gave the example, you lose 20% of your equity overnight. over the course of the year. So I go, hey, Apple shares are down. I've got this extra 20 grand here. I'm going to go buy, like, is there some sort of like, would you cut that off at a certain point to protect your bottom line?
No, we don't. And in fact, so we've thought about that. We've thought about the ways to do it, but we also want to make this a true partnership. We don't think, generally speaking, that we're, looking at another 20 or 30% decline. And over the long term, homes appreciate 2 to 3% a year, right?
Yeah.
And if you look at who we're talking about as our main buyer, could someone come in and pick us off and buy the whole thing and I'll lose 20% on one home? Yeah, I mean, it'll happen for sure. But, normally if you're talking about the first-time home buyer, the millennial who's, getting into home ownership, will they take another 2 or 3% from me down 20? Yeah, maybe, right? But now what do I have, right? I have a customer who's happy with me. They're into the product. Yeah, I may have lost 20% on those 2 to 3%, but, are they more or less likely now to sign a subsequent lease with me? Are they more or less likely to want to continue on with Fleq during this process? So I think I now have a much stickier customer because they now own more of the home. The home will be better taken care of. So we go through all that. So I understand that, yeah, we could definitely take, a hit here or there. But I think in the grand scheme of things, I'm going to get taken advantage of far more with, you buy your home in January, right? It's December. You've realized the property's appreciated 5%. We haven't revalued it yet. You're going to go in and try to buy as much equity as you can in December before I revalue it at the new price. I'm going to get more, quote unquote, picked off, in those types of transactions. And again, we're fine with it. We understand it's going to happen, but again, we now get a stickier customer. We get someone who's happy with the product. We just think it's worthwhile. We just don't see this as a downside trade. And if it's long term, yeah, obviously if it goes down 20 for multiple years, that's a problem. But historically, two things have happened, right? The only thing that goes down goes up in a recession is rents. People get forced out of their homes. They end up having to rent. So every new property we buy is going to be at a lower price with a likely higher rent cap. So, again, there's all these push-pull levers. I don't really think of us as a boom or bust kind of company. I think that we do well, in any cycle. But there are definitely some opportunities for the customer to pick us off, and we're fine with it in the design of the product.
Gotcha. Okay. Yeah, that makes a ton of sense. What, let me ask you this, what's most misunderstood, about what you guys are doing? So I'm sure you're having lots of conversations, whether that be with investors or, reporters or, media just in general. What's the most misunderstood thing so far about what you guys are doing?
Wow, there's several, and they all come from, to what you were saying before, it's looking at something and shifting it, 90 degrees and being able to see what it is instead of what it was. It's constantly, well, in a mortgage this and a mortgage that, we do get a lot of it. How does the payment compare? We've had some reporters ask for a math example. Can we create a math example? And I'm like, look, that's fine, but let's talk about the total cost of home ownership, because again, with interest rates where they are today, there are not too many rental caps that are lower than interest rates. So if you want to look at just rent to, just mortgage, yeah, I'm going to lose all the time. It doesn't make sense. But if you're coming in with 5% down and I'm paying 95% of the closing costs, I'm paying 95% of the home ownership costs, you need to start adding those in. And when you look at the total monthly spend on housing versus a mortgage versus us, like we start to look very comparable. It's not that different, when you talk about the total amount, and sometimes we're higher and sometimes we're lower. I'd love to say we're always lower, but that's not the case. But then again, it's what price are you going to pay for these conveniences? What price do you pay for equity portability? What price are you willing to pay for being able to call someone at 2 a.m. to come fix the plumbing as opposed to sort it out yourself? And so, I think when you add up the total ball, the total package of what we bring, I just think it's very different. It's going to be very, very appealing to, a large subset of people who, might otherwise think that home ownership is not for them. So again, to really answer your question, it's really kind of getting people to think outside of the mortgage sphere, right? Everything's always in terms of a mortgage. Well, why do you do this way? Well, it's kind of necessitated by the product. Well, why don't you pre-qualify people? Well, look, we're going to work to get there, but we're really pre-qualifying you on a rent and backing into, the home price, right? So, it's kind of a reverse of what you do because, again, you'll know better than I am, but let's just say that the average rent cap in Phoenix is 7%. Well, what we do is we're going to end up qualifying you for a mortgage or for a rent. And we'll just say it's $1,000 to keep the math very simple. And we're going to say the annual rent is, $12,000. What is the reverse of that cap rate to get you to a price that we're willing to say, this is the price of the home that we'd be willing to go to. So again, it's thinking about things differently. It's, when you're shopping for a rental, you're not shopping, necessarily. You're looking at the rent, you're thinking about what you can afford, but you're shopping very differently than you're shopping for a home. And we're trying to basically tailor, our needs to who the people we're primarily targeting, which are people who are renting homes or feel like they're on the outside looking in, and they're much more familiar with that rental process or how they go about acquiring a rental home or apartment than they are buying a home. And so we tailor our processes along those lines. So it's really about, like I said, all the major questions we get are, or the confusion, or why do you do it this way? Why do you do it that way? Well, we wanted to bring certain features to bear, and this was the structure that allowed us to bring the most features to bear with, in the most, economically efficient way possible.
Let me ask you this: like, how big can this get? Like, what's the potential for your company on the upside?
Well, look, I mean, depending on how you view this, I mean, we think there's, depending on what metric you've seen, generally people say there's more than $30 trillion worth of, residential real estate in the U.S. Okay, that's our market. Okay, maybe it's not. Maybe it's $4 trillion. That's what's rented in the U.S. I do know that when we look at, what is 0.1% of that amount, that would be about 11,000 customers. And if we did that on a yearly basis, we'd be like the 20th largest mortgage originator. So, I mean, I think that there's a huge market for us measured, kind of in the trillions. And there's plenty of room for people who will come with, similar ideas or different ideas, just like there's room for Quicken and Wells Fargo and B of A and, all those people in mortgages. We just are happy that we're able to bring this product because what I think, and, again, we've done a lot of, looking across the industry, what our competitive landscape looks like. There's a lot of people pursuing home affordability, right? There are people that will give you 10% down payment for 35% of the upside in your home. There are lots of guys who will say, okay, rent for 3 years at a premium price. And that premium over market rent becomes credits that will help you get a mortgage in 3 or 5 years afterwards. But we're the only guy who says a mortgage is not the right way to go for a lot of people, right? They're either down payment assistance or bridges to mortgage. We think that again, to keep borrowing your quote now, we just think you need to turn home ownership on its axis a little bit and look at this a little bit differently. And you'll come to a product that we think that makes a lot more sense given, kind of the needs and wants of the millennials and the Gen Z and the post 2008 people who are, locked out or locking themselves out in the case of the millennials and Gen Z.
Gotcha. So I'd be remiss if I didn't ask this question, and quite frankly, I just thought of it. So, the vast majority of the folks that listen to this podcast are in the real estate space, and make their livings like I do as a realtor. You mentioned earlier not having to work with Fleq, like if I was selling the home, but what about the buying process? What if I've got if I'm an agent and I come across someone and they've got the down payment money, but this just sounds like it might be a good fit for them. Is there room for me to work with you guys? And again, I've got my real estate agent hat on right now, or is this where, yeah, you know what, it's going to be good for them, but this is a scenario where I'm not involved at this point?
No, it's 100% good for you. Whatever you've agreed to with your customer and you bring that customer to us, you should think about us like a mortgage originator, right?
Okay.
You're basically just turning them over to us for that process. We're not involved with that. We're not going to try to cram down your commission or say you got to work for less. That's not what we're doing, right? We're here to own homes in partnership with people. And if they come from real estate people who you've already made the bid, and now we got to figure out how to substitute the partnership in for the person and remove the financial contingency, we want to be working with you. I don't want to do that process. That's not what we're here to do. So I think that's something that's really clear. And not only that, we would love to get to the point where, we're generating, a lot of referrals off of our website. There are people that, need realtors.
Yeah.
And quite frankly, we're not trying to remake that market. I'm going to need to offload them to people, because even though Fleq is, we're launching in Pittsburgh. I don't know if we've even we about that. And, we hope to be in about 7 states by call it the middle of this year. My highest and best use is not to be a real estate broker and be out there showing you homes, in Pittsburgh or wherever that is, right? We want to get partners. We want to be able to refer people out to you. This person's pre-qualified. This is someone that's good. We have realtors that, large realtors that we're talking to who get tens of thousands of rental leads every year, and they go straight into the garbage, right? And you know why? Because it doesn't make money for you to pursue renters.
Yeah.
But if you give them to me and I can qualify them as now a homeowner, and I can give them back to you, and I get a membership fee and a new alliance out of this, like that's a huge win-win for both of us. So I don't think of us as being any way competitive, with what you're doing. I mean, I think I'm adding potentially millions of homeowners nationwide, or millions of potential home buyers with whom you can be getting commissions. So, and it's definitely a sensitive subject. And we've had some realtors come back at us. Oh, I see you're licensed. Are you going to be hiring brokers? Are you only going to offer this to brokers that you hire? And I'm like, look, we're going to hire some real estate agents, because when you talk to Fleq about a specific property, we're conducting real estate activities, and that person needs to be licensed.
Yep.
So, we're looking for realtors who want a 9-to-5 job and not selling homes, and quite frankly, not a lot of them. And we plan on using, reciprocal agreements with other states so that they can get other licensing there. So when, Pennsylvania has reciprocity with Georgia, for instance, right? So my Pennsylvania, real estate agents will get licensed in Georgia. And when someone from Georgia comes in, they may be talking to someone in Pennsylvania who has the Georgia reciprocal license, but is allowed to talk to them and, negotiate the lease and do all that kinds of stuff. So we're not, I want to be very clear, we're not coming after your dollars. We're trying to add dollars into your pocket by way of increasing home ownership.
Yeah, that's cool. So, love that. Tell me, okay, so you're launching in Pittsburgh. You said goal of 7 cities by the end of 2020. Do you have a sense, and if you do, can you even share that with us where you expect to be this year?
So, we can't really get into the details. Some of them will also be, kind of funding and licensure specific.
Okay.
But, again, we'll probably, we're licensed in Pennsylvania. We'll roll out in Philadelphia. We want to do it in Pittsburgh. We think we know the process. Like I said, we've been in mortgage and real estate finance for a long time. But until you actually go through the settlement process and see how it works, and there'll be people that come to us that you've got a guy, the bid was accepted, financing contingency. Oh no, they can't get a mortgage. What do I do? And we'll get people that get inserted that late in the process and want to become a Fleq customer, right? So whether you've started with us from day one or you come unto us at the last minute, we're going to have all of that, and the process will be a little bit different. And, but we've been working with a lot of very expensive law firms to make sure we have the right disclosures and, everybody's comfortable, because, we do want to make this look a little bit like the a mortgage buy, right?
Yeah.
You're used to seeing a TRID document. These are my fees. Well, technically I'm not a credit product. I don't really have to do that, but we're doing that because I want you to feel like this is a process that you're, part of and owning along the way. Here's the disclosure for the partnership. Here's your disclosure for the lease, and we'll piecemeal it out in one pager so that people can, get comfortable with the process. So, again, we're working to make sure that, we think we have a recipe that leads to a cake. We want to make sure that when we put the ingredients together, there's an actual cake, and then we'll start rolling out. But, I would think Philadelphia kind of rolling down I-95, maybe getting to Atlanta by the end of the year, and then we'll start picking cities and other states, kind of beyond that. But please take that as only, something more than idle speculation. But, that's the most likely scenario for us.
That's awesome. Well, hey, Todd, I really appreciate you taking the time out of your busy schedule today to share with us. I love what you guys are doing. If someone listening to this podcast wants to learn more, hear more, is the best place just to go to the website, fleq.com, which is FLEEQ. By the way, I'll put that in the show notes. Is that the best place to reach out?
Yeah, so it's the best place. And Fleq is actually, we didn't even talk about this. This is exceedingly remiss of me. Fleq is the combination of the words flexible and equity. So flexible, FL, equity, EQ, and that's kind of how we came up, kind of with the name, of the product. But that's the best place. You can reach out at info.fleq.com. That's an email that'll go to, it goes to a generic email box right now, but we generally are answering that pretty quick. And my guess is, and again, this is a little bit more than idle speculation, but we will have a customer service number that gets posted to our website. My guess is in about 7 to 10 days. Okay. And you'll be able to then have conversations with varying levels of personnel from, just simple entry calls to, I want to talk about Fleq, but not about the specific property, all the way to, I want to talk about Fleq with a specific property, and we'll get you routed to the right person. So all of those things will be, kind of up in play in the next, like I said, week to 10 days. So those will be the best places to be in contact with us.
Awesome. Well, again, like I said, I really appreciate you taking the time today. Thanks for being on the show. And I hope if there's anything else I could do if there's anything I can do for you, or any last comments you want to share with us before we go, now's an opportunity. And again, just wanted to say thanks.
No, I appreciate that. No, nothing else. And again, if you get people out there who want to, get in contact with us, you've given the way. I appreciate the time and the opportunity to tell the Fleq story in our voice, as opposed to, the idle speculation we've seen on some of the internet sites about, how we're going to get everyone. So I do appreciate that. Thanks, Kevin.
Yeah, for sure. Have a great one, and we'll talk to you again soon, I'm sure.
Thanks.